The housing market is about to be destroyed in 2025. These are the headlines that you often see about the housing market. Have you ever wondered that whenever you hear the news about the housing market, it's about to collapse? Either the market is about to collapse, or it has collapsed, or we are just recovering from the collapse. So that led me to ask myself a very simple question recently. What is wrong with the housing market? Why on earth did the housing market just keeps collapsing? Why can't we just have a simple market that works effectively and it keeps growing? I mean, if you take a look at the history of the United States, whenever we had like a major crisis, the housing market actually collapsed. So if you look back at 1929, when we had like the Great Depression back then, of course, it wasn't like a housing crisis back then, but because the stock market collapsed and the economy literally went down into a recession and then a depression that lasted over a decade, the housing market also collapsed at this point, which was a disaster. And then if you go back to 1990s, we had another crisis. Now, 1990s was different. It wasn't like a major housing crisis, but because the economy literally went down at this point, the housing market probably declined by 8 to 10% at that point. However, that is absolutely nothing compared to what happened in 2008. Now, 2008 was something different probably in the entire history of the United States. A lot of people today who didn't actually live the crisis back in 2008 don't really understand the grasp to what extent the market actually crashed, because it's actually called a housing crash, because the entire market or the entire economy went down not because of the stock market, but because the housing market was so ineffective and it collapsed and took with it the rest of the economy. Because if you kind of zoom out the US economy and take a look at it, you'll find out that the housing market actually makes up a huge percentage of it. And because the rest of the world, the other economies, especially the allies of the United States, are connected to the US economy, guess what happened to them? All their economies went down as well. And even the countries that are not allies of the United States, but major trading partners such as China, China also at that point experienced a significant stagflation back then because their main market was the United States. And now what's happening at this point is that a lot of people are actually talking about another housing crisis that is about to be faced, maybe 2025, maybe 2026, or maybe after that. And a lot of people even expected the crisis to actually happen in the last 2 years, but it didn't happen. But what we know for a fact at this point is that, yes, most likely there is going to be another housing crash where house prices could collapse by anything between 7% to probably like 20%. Can we say for a fact when exactly that is going to happen? Well, absolutely not. So have you ever wondered what's wrong with this housing market? Why exactly does it constantly keeps crashing? Why can't we just build an effective, great housing market where it just grows gradually? Everybody can simply buy a house and nobody will simply worry about what is going to happen to the market. Because when the housing market collapses, it has catastrophic effects on the economy. When the stock market affects, it doesn't really have such a huge impact on everyone. Because if you take a look at what's happening to the stock market, the top 10% of the stock market is owned by the top 90% of the stock, the entire 90% of the stock market is owned by the top 10% of the people. So whenever you see that the markets are going down, you don't really care because it's those rich people out there who are actually losing money at that point. But when you see that house prices are going down, who's suffering? Exactly. The average person is actually suffering because his house, the value of his property, the value of his biggest investment of his life is actually drastically going down. And that's why 2008 had such a catastrophic impact on the entire US economy. But in order for us to answer this question and understand what exactly is happening here, we have to ask ourselves a very different question. And that is, how does prices work in the housing market. Because if we understand how prices work, then we can actually predict what exactly is happening. Now, the way I like actually to solve problems is very simple, and a lot of people probably do that like that as well. When we have a crisis or when we have a problem, instead of actually looking at the symptoms of the problem, why don't we just break down the problem and understand where it's coming from? What is the source of that problem? What does the mechanism actually looks like? How exactly does it works? So when we go to the source, we can actually find out where it's coming from. And then we can rationalize and understand the system and find out why does it keeps constantly crushing. So right now, let's try to understand how prices work in the first place. If you actually take an economics 101, you understand how prices basically in the market works. So I have drawn a little chart over here to illustrate to us how exactly does it works. So in this little example, I'm going to talk about micro situation, not the entire market, but just, about one house, about two houses, about a few houses. Because if you understand how the system works on the micro level, you can take the exact same logic and apply it on the macro level, and it all will start actually make sense to you. So let's try to understand how does it looks on the micro level. If we have such an equation where below we have the quantity and here we have the price, so at this point we have an equilibrium where if we have 50 houses in the market, as you can see right here, then the price for those 50 houses are going to be $500,000. Now, this is, of course, a hypothetical example. You can actually get out and draw anything you want. But what we want to understand, like the point of it is that how exactly prices actually change at this point. On one side, we have here with blue, which is our demand, and then we have the supply. So whenever any of those factors actually change in the market, suddenly you will start that the prices are actually moving. Either they're rising or they're actually coming down. Let's take a very simple example in this case. Let's say that demand in our case is going to rise. Suddenly, people are making more money, the economy is growing, whatever the reason are going to be, the demand for houses is going to rise. And when the demand rises here, the line of demand is going to move to the right. So this is going to be our new, let's say, demand line. Let's call it demand 2 at this point. So what exactly has happened here? The price actually increased at this point. Why? Because the demand and the supply has actually stayed the same. And that's why we have an absolutely new equilibrium at this point. This is going to be because at this point, there is the demand for 70 houses, and that rises the price, when in reality, we have, let's say, just 50 houses at this point. And that's why, because the demand shifted to the right, because the demand has increased, that actually led the prices to increase. And now let's take an example of what is happening at this point where the supply is going to change at this point, where the supply is going to be raised. What does that mean when the supply in the market rises? That basically, in simple words, means that construction companies start building more houses at this point. So if they start building more houses, then the line, let me change the color so that actually makes more sense and easier to understand what's happening here, is that when the supply actually rises, it also moves to the right. And when it moves to the right, we have a new equilibrium, which means a new price. And the price is lower at this point. And the reason that the price actually has been reduced is because demand stayed the same, but supply actually increased. And the easier way, or the easiest way for you to understand that, imagine you have a house in a neighborhood that the person or that homeowner wants to sell. If you have one person who actually wants to buy that house, then that homeowner is actually limited to a bargain. Because if he actually going to put a much higher price, that person is going to say no, and that's the end of the deal. And his intention is to sell that house. So he's very limited with his negotiation and raising the prices. Now take the exact same situation and the exact same house, but on the other side we have 10 people who are trying to buy that house. Now if the landlord who is trying to sell the house is going to raise the price, let's say by 20%, yes, some of those people might not want to buy that house because it's just too expensive for them, or they just feel that it's not worth it. But there are 10 people, and let's say 3 of them will agree. So suddenly he can actually raise the price and there is still going to be a buyer. And that's the point of the demand and supply. And in order to understand what is happening in the market, whether there is going to be a crash or there is going to be a recession or the prices will increase or rise, all you have to do is to take a look at what's happening to demand at this point and what's happening to the supply. Because if the supply of houses, for example, shrink, let's say this is our, let's say supply 3, let's call it supply 3 at this point, and the line of the supply has been shifted to the left. What's happening at this point is that prices has increased because the supply of houses, the quantity of the houses in the market has decreased, and that's why we have a new higher price. But if the demand here lowers down, let's change the color so it actually will be easier for you to understand. If the demand at this point is going to the left side, so what happened is that less people at this point want to buy that house, and because less people wants to buy that house, the price is actually being reduced. That is very simple economics. That's called demand and supply economics 101. I hope it actually just gives you an understanding of how the price moves whenever the demand moves and the supply moves. But the entire point of understanding this is that if we want to understand the direction that the market is headed to, all we have to do is that understand where the demand is going to be, or where the demand is, and where the supply is, and where the supply is going to be. And whoever can control the demand or the supply can control the entire housing market. So is it possible to control the entire demand and supply? Well, in the 21st century, I mean, not the 21st century, but let's say in the modern capitalistic economy, we have created a tool called a mortgage. So a mortgage is a very powerful tool. If you take a look at a mortgage is basically you go to the bank and you take a loan and then you buy a house. Because houses are expensive. So if you're making $100,000 and the house costs $1 million, even if you save every penny without spending anything out there, it will take you 10 years to save that money to buy a house. And because you have a life and you need to at least maybe rent something, you need to put food on the table, you need to buy water, you need to fuel your car, you can't be saving your entire savings, your entire income in order to buy a house. So buying a house for you just becomes super impossible at this point. And that's why most people will never be able to afford a house. So we created a financial tool in order to make it easier for people to be able to afford houses. And that financial tool is called a mortgage. The bank is going to give you a money, or a loan in this case, and you will be able to buy the house. And then you will be paying off your loan, and that loan is going to have an interest. So it's called a mortgage, but it's simply a loan. It's a long-term loan to buy a house, and for some reason it's just called a mortgage. I don't really know why did they call it a mortgage, honestly, but it doesn't really matter at this point. And if you zoom out and take a look at the US housing market, you will understand that around 70% of all the houses that is being purchased in the market are purchased with a mortgage, are financed with a mortgage. It's not because people have money. It's not because people are rich. It's not because people can afford them. No, it's because people are going to the banks, borrowing money and buying houses, period. And what does that actually tells you about the demand? So if you can control the mortgage, you can control the demand. If you can decide how many people will get a mortgage this year, you can basically predict how many people will buy houses. And that is why the government has a very effective tool to actually control the demand at this point. So if you take a look at all the tools that the government is using to actually control that mortgage, then you will be able to understand how many people are going to buy a house and how high prices are going to rise. One of the main methods is something called regulations. So what is a regulation? If you go to the bank and you borrow and you try to get a mortgage, there are a series of questions that they're going to ask you. They won't simply just hand you the money. There are a series of laws that the government has passed. So, for example, the government is gonna issue a policy that only people who can have an income of at least $50,000 will be able to get a mortgage. or only the people who have had a stable job for at least 2 years will be able to get a mortgage? What did you do just now? Now you have separated a group of people who can actually get a mortgage, and the rest of the population cannot get a mortgage. Everybody else who makes less than $50,000. But then if the next day the government is going to pass a legislation or a law that will say that you don't need a $50,000 threshold to get a mortgage, suddenly the number of people who can get a mortgage increases because there are less regulations at this point. So the number of people who will buy a house will suddenly increase. So more regulations means less demand, less mortgages. Less regulation means more mortgages. And that's one of the simple ways of how the government can actually make borrowing, getting a mortgage easier or more difficult. Easier means more mortgages, difficult means less mortgages. Less mortgages means less demand, more mortgages means more demand. Now, the second way that the government actually controls the market is through interest rates. Now, the Federal Reserve, the source of the dollar, is part of the government technically, but it's not. That's a different debate for another video. But the point is that if you go and borrow a mortgage, it has an interest rate. For example, it has a 5% interest rate. And if you borrow $1 million with a 5% interest rate, that means that every single year, I'm just simplifying everything. It's going to be slightly different because the math behind it's slightly different. But the point at the end of the day is pretty much the same. So if it's $1 million mortgage with 5% interest rate, every single year you're going to pay $50,000 just to cover the interest on your mortgage. But suddenly, let's say, for example, a hypothetical example that the government is going to drop the interest rate to 1%. And now you can get a mortgage at 1% interest rate. Suddenly, instead of paying a $50,000 interest rate payment every single year, you'll be paying a $10,000 interest rate payment. What does that tell you? It means that getting a mortgage became cheaper, aka buying a house became cheaper, aka more people are going to get a mortgage, which means that the demand for mortgages are going to rise. And vice versa. If the Fed is going to raise interest rate, mortgages will become more expensive and less people will actually get them. So these are basically the two main instruments that the government is using to control the demand in the housing market. And the more the government controls the demand, the more it decides which direction the market is going to be headed to. On the other side, the government controls the supply. So, for example, if you are a construction builder and you want to build a house, you can't just randomly go and build whatever house you want. There are a series of rules and regulations and policies that you have to meet. For example, you need a permission to buy a land. You need a permission to build a house. And then if you want to build a house, you have to follow certain rules and policies. You can't just build random things, right? So the more regulations are there, the less people will be actually build a house. So if there is a law that says that in a single year there shouldn't be built more than 100,000 houses, that means that there is not going to be built more than that number of houses. But if the government will suddenly take out that regulation, and suddenly there is no limit to how many houses that could be actually built, more houses will be built. If it takes right now, for example, a year to get the permission to build a house, then less houses will be built because you have to apply and then you have to wait for 1 year in order to get that permission. But if the government, for example, will make getting an approval to build a house and will shorten it to a single week, for example, now the number of constructions will actually increase. So there are different ways that the government can manipulate how many houses will actually be built. There are also tax credits that the government can actually give to people, or the corporations in this case, in order to build houses. So if a company builds, for example, a certain number of houses, it will get a tax credit. Suddenly these companies have an incentive to build more. But if the government takes out that incentive, then they don't have that incentive and less houses will be built. So in other words, you can say that this is basically the government, and these are basically the people and the construction companies, and the government basically playing around with them in order to kind of adjust the market the way they want it. But then we have the corporations who have the money, and they can use this money basically to control the government and pass legislation that will benefit them instead of these people, for example. And that's another story. But basically this picture perfectly illustrates how the government basically controls the demand and supply. So that takes me to a whole different point here, is that if we make it easy to buy a house through a mortgage, everyone will buy a house even if they can't afford it. So ask yourself a very simple question. Don't we want a society where everybody can own a house? Don't we want a society where everybody has a roof over their head? I mean, that's a perfect utopia. Why can't we just make mortgages affordable to everybody? Let everybody has a house. Wouldn't that actually make sense? Well, absolutely, and I really would want that. But the problem with making it so accessible to everybody is that not everybody works as hard, equally hard in the market. Not everybody has equal payment in the market. So there are people who are rich, and then there are people who are poor, and then there are people basically in this entire diagram, closer to being poor or closer to being rich, or maybe somewhere in the middle. Some people can afford and are responsible. They will take a mortgage and they will make their mortgage payments. And then on the other side, there are irresponsible people who will take a mortgage and they will not make their mortgage payments. So if we kind of lose out the regulations and we let everybody to basically be able to buy a house, let's say we just make interest rates 2% and then we take out all regulations and everybody who wants to afford a house will be able to afford a house. Period. It's as simple as that. Let's do that, right? Everybody will go to the bank, get a mortgage, and buy a house. And then we'll restrict all regulations from the suppliers. So what will happen is that prices will suddenly rise, as you can see right here. So if the first price was $500,000 because the demand was at 50 houses at this point, the demand rises, we have a new equilibrium because at this point, I just made an assumption that supply stays the same. What happens is that prices, the demand of houses has increased from 50 to 90, and then we have a new price over here, which is $800,000. So if we make regulations loose and we lower down interest rates, while on paper it sounds great that everybody will own a house, suddenly house prices will actually rise. Well, isn't that amazing? Well, on one side, it's amazing because so what? Let the prices rise as long as everybody can afford the house. But that actually creates an absolutely different challenge. Let's make an assumption that we're going to make it easier for everybody to build a house. We're going to take out all regulations. Every company that wants to build a house, let them build. Everybody who wants to build a house for himself, let him build. You want to build a house tomorrow? You can get your permission overnight. What happens in that case? Suddenly, the supply of houses is going to increase, and that means that prices will suddenly drop. So when the demand was 50 because there was less houses in the market, the price was $500,000. On the other side, when supply suddenly increased, the new price, because the new demand is 80 and the prices dropped down to $200,000. So there's ups and downs. Now, some people might say, why don't we just increase the demand and at the same time increase the supply? Is that a possibility? Well, in some sense, yes, there is a real possibility to do that, but there is a fundamental problem. You see, when we increase the demand to this point and we have a new price over here, let's say that we have actually, let me just change that for a second. Let me try this. So let's say, for example, we have increased the demand and the new price is 800,000. And then let me change that for a second. And then we are going to increase the supply. So our new price is going to be somewhere over here. So our price is going to be $650,000 and our demand, let's say, is going to be 100 over here. That sounds perfect, amazing. We increase the supply and we increase the demand. And now ask yourself a question. What happens when all of those irresponsible people who took a mortgage cannot make their mortgage payments? Imagine somebody has an addiction. Yes, he got a mortgage and now he can't make his mortgage payments. Or imagine somebody who doesn't have a stable job. He got a mortgage, 6 months down the road, he can't make his mortgage payments. Imagine we have somebody who faked his numbers and now he got a mortgage and now he doesn't have a job to make the mortgage payments. What do you think is going to happen? Suddenly, the demand starts going down. The demand starts going down here. So the demand is here, that's the new price, but people are buying at this price, which means $600,000. Now, those people who actually couldn't make their mortgage payments at this point, for example, what happens to them? They will put their houses on sale to the market, which means that supply will further increase in the market. So the prices will actually crash catastrophically. So it's extremely dangerous to actually let people get a mortgage if they can't actually afford it, because the people who are actually can afford and are responsible with their mortgage payments, their house prices will collapse. And imagine you have a house and you purchased it, let's say at this point at $650,000. And suddenly, because all of those irresponsible buyers got a mortgage, cannot make their mortgage payments, cannot make their mortgage payments, and the demand went down, prices have decreased. And then they put their houses on sale. Now suddenly there are more houses in the market, which means that prices further increase. What do you think happens to your house price? Your house price go down at this point to $300,000, but you are making a mortgage payment for $650,000. What are you going to think? Well, I don't want to make that kind of a payment when the real price of my house in the market is like $300,000, half that price. So I might as well also sell my house and get a second mortgage, or a new mortgage in this case, and buy the house for half of the price. So that creates a catastrophic cycle in the market that we call that supply rises, that drops the price. That leads the price to drop further, and people sell more. People sell more, that again leads more people to sell more, and prices go down as well, and that will increase the supply in the market. So that creates this endless loop in the market that keeps driving prices down and down and down until house prices reach $0. That is the danger of actually losing up regulation to the point where everybody can afford a house. And that's why house prices collapse all the time. It's very basic math and very basic mathematics. And the reason we repeat the exact same mistakes is because we have politicians who take policies or promise things that don't really understand how the economy overall works. And let me give you a very simple example. The 2008 housing crisis is a perfect illustration of what I've actually just explained to you at this point. So in 2008, the housing market actually collapsed, and everybody knows what exactly has happened. People lost their jobs, it affected the entire economy, and a lot of people saw the value of their houses to literally drop by 30 or 40%. And why exactly did that happen? Why couldn't we actually predict that? So in the year 2000, there was this thing called the American dream. The American dream has always been, but politicians always talk about that the American dream is dead, because the point of the American dream is that everybody can afford a house. But now it's the year 1990s and 2000s. Nobody can afford a house. So politicians in the 2000s made a claim. We need to make housing affordable again. Everybody in the country must own a house. Now, that is a very beautiful slogan. That is a very nice thing to say. That is the kind of thing that you say that will actually get you elected to the Oval Office or the Congress or wherever you want to be elected, or the mayor of your city. So that kind of movement started rising in the United States, and the demand for ownership was literally extremely strong, and politicians wanted to change that. So the way they actually fixed that problem is very simple. They deregulated the financial market. And I don't like that because we can't really see anything over here. So let me change that to this color. So they deregulated the financial markets at this point. And that basically means is that they took out regulations and made getting a mortgage much easier. So they repealed the Glass-Steagall Act at this point, and then they passed the Gramm-Leach-Bliley Act. These two acts basically gave the corporations more freedom to invest in different kind of aspects. A lot of other policies were passed in order to make it easier for people to get a mortgage. The Federal Reserve dropped interest rates to the point where most people could actually get a house. So that's exactly what happened, just what we talked about earlier. Because it's easy to get a mortgage, what do? You go and get a mortgage. And when you get one mortgage, you want what? You're thinking, wait a second, I'm a genius, because what I can do here is that I will become a real estate tycoon. I will get a second mortgage, and I will take that house and I will rent it out. Have you ever thought about that before? Of course you did. That's a very simple, easy business plan. You're the only one who thought about it. Fantastic. You don't have a job? Who cares? Your renter will pay your mortgage. You're very bad with money? Who cares? It's as simple as just taking the rent from your tenant and just paying it to them and just paying it to the bank. So a lot of irresponsible people who are really bad with money, who don't have stable jobs, or whatever their reasons are, started getting a lot of mortgages because now it's very, very easy. And the government made it easy for everybody. The government also made it easy for construction companies to build as many houses as possible as they could possibly can. So the market was filled with houses and everybody was buying houses. 1 house, 2 house, 3 house. And when you have a big market, what do you think happens at this point? The great thing that happens all the time is that on the other side, you always have people who are hungry and want to make money. And we call them investors. We call them investors, Wall Street, investment banks. I mean, everybody who actually wants to make a market out of this booming market. Everybody who wants to make money out of this booming market. So the banks came out with a brilliant plan to actually help investors and themselves to make a lot of money out of the housing market. They came out with something called mortgage-backed securities. It sounds very scary, but it's very simple terminology for a security that is backed by a mortgage. So you have, for example, you have a government bond. That is called a security. You can buy a government bond and then the government owes you an X amount of money, for example, plus interest. So what the banks try to do is that they would take a bunch of mortgages together and then they will take a lot of these mortgages, put them under one security, under one document, and then they will sell it as a loan to someone else. So basically, this is the bank, for example, on one side, and then they will borrow, or I would say that they will lend the money to the borrower. So the borrower actually got the money, and this is the loan that we have over here. So the loan was actually given by the bank over here to the borrower. So the borrower owes the bank some money, and then the bank will take this loan and then it will actually sell it to an investor. So now this borrower owes money to the investor and not the bank anymore. And the bank is like, at this point, we created a debt and then we sold that debt to some kind of investor, and now some kind of homeowner owes money to that investor, and we don't have anything on our balance sheet. This is no longer our house. It's no longer our mortgage. Guess what we're going to do now? We'll just do that. We'll get a lot of mortgages and sell them to investors. And the way they actually kind of manipulated the market is in such a brilliant way. They would take, for example, there are different kind of borrowers, right? So if you are a responsible borrower, let's say you're making a good amount of money, your credit score is extremely high, you are a very responsible person, you have a very stable job, and so your mortgage has a AAA rating. On the other side, you have somebody who doesn't have a stable job, who doesn't make a lot of money, who has a very low credit score, and has a lot of credit card debt, for example. So the bank would actually take 60%, for example, really great mortgages, and then 40% bad mortgages, and would put them together under one security. So one piece of paper, one mortgages, and then they will sell it to an investor. The banks actually saw a great opportunity here, and they started making a lot of money. And that's why the market started exploding at this point, and everybody was making money. These guys were happy, the banks were making a lot of money, and investors were making a pretty decent returns. But the banks actually took it to a completely different level at this point. They started actually getting something called collateralized debt obligation, or CDOs. You might have actually heard about it, and the idea behind them was very simple. This is a security, let's call it. Now let's change the colors again. I guess I'm gonna change the pen. Yeah, it is basically a security. So inside this security, the banks will take the bank loan, mortgage-backed securities, credit card debts, bonds, and different kind of other loans at this point, and then they will put them under one security, and then they will sell them to an investor at this point. So, for example, car loans are riskier than mortgages. credit card loans are riskier than auto loans. But then they will just got them all together under one umbrella. And because this security has a lot of mortgage-backed securities, the rating agencies was actually rated as a high rate, even though that maybe 10, 20, or even 30% of those loans within such security are credit card loans. And credit card loans are extremely unstable and very risky. So what happened at the end of the day is that all of the things that we have discussed here, what they did basically, they first of all increased the demand, as you can see over here. So the demand started rising and we have a new price. On the other side, because the government made construction companies easy to get permissions and build houses, that increased the supply at this point. So the supply has increased. So we have a new equilibrium. The price before was $500,000. And then the demand was 50, just a hypothetical example. The price has increased to a new equilibrium, which means that the demand is 20 at this point. But then what we have is that the price has increased to $600,000. Well, it's not really a big deal. The price increased by just $100,000 and then everybody has a house at this point. This is fantastic. This is great. But what do you think happened when the demand went back to its previous position? And why did it go to its previous position? Very simple. All those people who couldn't afford their houses suddenly started selling their houses in the market. So the price went back to this point, and then the supply decreased further. So we have a new equilibrium over here where the prices have collapsed. So the demand decreased, supply increased, and all those people couldn't afford their houses, and the market suddenly went from $600,000 to $250,000. And that's what we call a market crash. So whenever you want to understand what's happening to the housing market, you don't have to be a super genius to understand what's happening. It's as simple as understanding what are the laws that is being passed by the government in order to influence the demand and supply. Where are the interest rates? What is happening to the supply side of the market? So that leads us to ask ourselves a very simple question. Will the housing market crash again based on the circumstances that we have on the ground today? That's the question that a lot of people are probably wondering at this point. So are we on the verge of another housing crash? Now, COVID-19 played an important role here because COVID-19 led the Fed to drop the interest rates to almost 0%, and that dropped the mortgage rates, of course, to like 1 to 3%. And because mortgage rates were so low at this point, everybody got a mortgage and house prices literally skyrocketed to the moon, you can see at this point. So a lot of people started predicting that all that demand is going to be crushed when the Fed is going to raise interest rate. So we might actually be on the verge of another housing crash, especially when that demand was fueled by extremely cheap interest rate. But the market hasn't crashed yet. Yes, it has slowed down. Yes, it has moved down in some states or maybe some cities. But overall, the market just, you can say that it hasn't been moved that much. It just slowed down. It stopped growing that fast, but it slowed down. So let's take a look at what the presidential candidates at this point are proposing to the housing market and how that is going to actually impact the market. So if you take a look at Harris' campaign, she's proposing to build another 3 million houses at this point. Now ask yourself, what is going 3 million houses to do to the market? If you're going to incentivize construction companies to build more houses, more supply in the market is going to bring prices down. She's also proposing a $40 billion for businesses that is going to build affordable houses. So she wants to give tax credits and incentives to companies that are going to build not luxury houses, not malls or something like that, but if they actually build affordable houses people can afford, the government is going to give them some kind of subsidies or maybe some kind of tax credit. So that will incentivize them. Again, what that will do to the market? It will increase the supplies drastically. She also wants to limit the investors to buy in bulk. So right now what we have is that we have a lot of huge institutional investors who are buying houses in bulk and then renting them out. So they will come to a neighborhood and they will buy the entire neighborhood and then they will set their prices and they will make money out of it. And she wants to limit that. The next thing is, of course, a $25,000 down payment to help people to buy a house. So if you want to buy a house and you can't afford it, the government is going to cover $25,000 of your down payment. So for example, if you're buying a $500,000 house, you have to put a 20% down payment, which means that you have to put $100,000 on it. Now, with this law, the government is going to cover $25,000 of that, which means that instead of $100,000, you can just get that house for just $75,000. I mean, that's the down payment, not considering that you will be making your monthly mortgage payments. And finally, a $10,000 tax credit for the first-time home buyers. So if you actually buy a house, $10,000 of the house that you're going to pay is going to be used as a tax credit in order to lower your taxes. So everything that Harris' campaign is actually proposing, she's basically increasing the supply and increasing the demand. Now, before I tell you what kind of impact this is going to have, let's take a look at what the Trump campaign is actually proposing to do to the housing market. The Trump campaign, honestly, there isn't like specific things they've actually said, because there isn't like a PDF file you can download and these are the exact policies that Trump is going to do to the housing market. So everything that I've watched Trump, I've read about everything he has said, his statements. So based on what I have understood he wants to do to the market, and based on his first presidential term, he wants to deregulate the market. So he wants to make it easier for you to get a mortgage. He wants to make it easier for companies and banks to provide you with a mortgage. He wants to take out regulations as much as possible. What that will do to the housing market? It will increase the demand drastically. We talked about that earlier. He also wants to cut regulations for builders. If now it will take you a year to get a permission, he wants to reduce it to 2 weeks, maybe probably 2 days. So if he will make it easier for construction companies to build a house, then the supply is going to be raised at this point. So demand is raised here, supply is raised here, and based on his theory, there should be a new equilibrium over here. He also wants to get rid of the sponsored enterprises that help mortgages. So now we have some government-sponsored corporations that help the people in order to lower down their mortgages. And he wants to get rid of that. That will lower down the demand. But overall, if you actually take a look at both of these candidates are proposing, it's pretty much the exact same thing that politicians proposed during the year 2000. They say the exact same thing. House prices are unaffordable at this point, and they're trying to do a few things that we did basically back then. Deregulate the market, take out all the regulations so that it will be easier for you to afford to get a mortgage. Let the builders build more houses. Of course, they're confronting this problem slightly differently, each of them, but the point of it at the end of the day is pretty much the exact same thing. So these policies, no matter who becomes the president of the United States at this point, will actually lead the demand to rise even faster, even though that the COVID has increased it dramatically, and lower down the supply and increase the supply further as well. On paper, it looks great. It looks fantastic. But can it lead to a disaster just like it did in the 2000s? Well, of course. That's why they say that the road to hell is paved by good intentions. It always works like that. So if you want to protect yourself, you can't really rely on the government or anyone else. You should educate yourself, learn how to invest, learn how to win in the stock market or any kind of investments. And if you need help with that, you can check out the first link in the description, and take care.